Markets are melting. Headlines scream chaos. Trillions of dollars gone in just days. Oil's crashing. Tech giants are tanking. And the US dollar? Losing grip. Feels like financial whiplash, right? In this chaos, Buffett is saying, keep your head if you're spooked by tariffs. What does this mean? In this video, I am going to break down exactly what's happening in the economy right now, what is triggering the economy, why the global market is blood red, why Buffett's voice matters more than ever, and how you can navigate this mess with a cool head. It started with a speech, one that set off a global shockwave. On April 2nd, President Trump stood at a podium on what he called Liberation Day and announced sweeping tariffs, minimum 10%, some soaring up to 50%, on nearly every import into the U.S. The message? Reclaim American industry. But the financial world didn't eight did czar the celebration. It heard alarm bells. Within hours, $2.5 trillion vanished from Wall Street. The Nasdaq plunged nearly 6%. The S&P 500 almost 5%. That's not a blip. That's a financial earthquake. Tech giants, the darlings of the last bull market, got clobbered. Apple and Nvidia alone shed $470 billion in value before the markets even had lunch. But it didn't stop at America's borders. London's FTSE 100 tumbled. Asian markets bled red. Oil prices dropped 7%, a warning shot about shrinking demand. The US dollar, usually a safe haven in turbulent times, dipped to a 6-month low. When even the dollar is losing its shine, something deeper is shaking. Then came the backlash. China retaliated by punishing the US with a 34% tariff, which has now risen to 84%. The European Union signaled its own countermeasures. It wasn't just about economics anymore. It was about dominance, a global game of brinkmanship with investors caught in the crossfire. Buffett himself said the tariffs are an act of war.
Stocks, as you know, trading once again near record highs. Does the market appear overvalued? Should investors worry about a correction?
Well, you shouldn't worry about, if you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Markets can absorb bad news. But what they hate, what truly rattles them, is unpredictability. This wasn't just an economic policy, it was a moving target. Traders, analysts, and everyday investors were all asking the same question. What's next? Will this spiral into a full-on trade war? Will inflation spike? Will global growth stall? The unknowns kept piling up. Suddenly, safe bets weren't so safe. Bond markets flickered. Gold spiked. Hedge funds hit the brakes. Big institutional players pulled back on risk. And Deutsche Bank issued a rare public warning. The US dollar's reputation as a safe haven asset was under threat. If the global economy can't rely on the dollar in times of stress, where does the world turn next? Let's bring it down to us, everyday people. Your 401k. If you have noticed, it has taken a hit. The groceries you buy, probably going up. Planning a big purchase like a house or car? Rates and confidence just got shakier. This isn't just something happening on CNBC, it's in your wallet, your job, your future. And when confidence cracks, people stop spending, businesses freeze, and fear multiplies. But here's what's important to understand. None of this is new. We've been here before. Maybe not in exact form, but definitely in effect. The dot-com crash, the Great Recession, COVID. Each time markets convulsed, fear spread, headlines screamed. But every time, those who kept their heads, those who stayed calm, came out stronger. That's where Buffett comes in. And that's why he says to keep your head when the stock price is falling. Buffett has lived through more financial crises than most investors have birthdays. He doesn't get rattled. Not when markets plunge. Not when pundits panic. Because to Buffett, crashes are expected, temporary, even useful. When the market's on fire, most people run. Warren Buffett's strategy is to tank it with his cash reserves and buy solid stocks on discount. This is how he thinks. Buffett has a saying, borrowed from the poet Rudyard Kipling. If you can keep your head when all about you are losing theirs, It's a mental framework that's made him one of the most successful investors in history. So what exactly is Buffett doing right now? Well, he's not panic selling. He's not glued to breaking news or watching CNBC all day. He's likely reading, thinking, and making a list of companies he'd love to own if their prices fall low enough. He's waiting, watching, ready. In moments like these, Buffett becomes what he always has been, a value hunter. And his advice to the rest of us is usually this: don't get caught up in the noise. When others are acting on emotion, that's your cue to act on logic. Buffett doesn't see a crashing market. He sees a clearance sale. Let's look at what he's actually said in the past. During the 2008 financial crisis, while others were retreating, he published a now famous op-ed in the New York Times titled "Buy American, I Am." He wasn't scared. He was investing, pouring billions into the U.S. economy while most were hoarding cash and watching from the sidelines. That doesn't mean Buffett ignores risk. In fact, he studies it relentlessly. But he defines it differently than most people. For Buffett, risk isn't about volatility, it's about permanence. It's not the ups and downs, it's not knowing what you're doing.
How do you think tariffs will affect the economy?
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, you know, the tooth fairy doesn't pay them. I mean, and see, you always have to just, and then what? You always have to ask that question in economics.
In 2020, when COVID shook the global economy, Buffett admitted he didn't know how the pandemic would unfold. He sold airline stocks, not out of fear, but because the facts had changed. That's another key lesson. Being flexible doesn't make you weak. It makes you wise. You don't stick to a plan just to seem consistent. You change course when reality changes. Now, in 2025, with tariffs flying, inflation rising, and markets sliding, Buffett's message is still steady. Stay rational. Think long-term. Ignore the noise. Look at what matters. And don't lose your head. There's a reason Buffett loves companies like Coca-Cola or Apple. These brands are reliable cash machines. He looks for businesses with strong fundamentals, consistent earnings, and products people will still use tomorrow, no matter what the headlines say today. This mindset doesn't come naturally. It takes effort. It takes practice. It takes stepping back and asking, what's really changed? Has the company's core business deteriorated? Or is it just out of favor for now? You have to understand that Buffett doesn't try to time the bottom. He said himself, he has no idea where the bottom is. What he does know is this: when prices fall and the business stays strong, it's time to act. And maybe the most important thing Buffett wants you to remember: you don't need to swing at every pitch. The stock market will be open tomorrow and the next day. You can wait for your perfect shot. That idea, that patience pays, is something most investors forget in times like these. So now that you understand how Buffett stays cool in a crisis, the next question is, how do you apply this mindset to your own investments? Let's break it down into real-world strategies that anyone at any level can use right now. So, how do you actually use Buffett's mindset in today's chaotic market? It's one thing to admire the calm from afar. It's another to apply it when your own portfolio's down, the news is grim, and social media is screaming, sell everything. Let's break it down into real, simple strategies you can start using today. First, think long-term. This isn't just a Buffett motto. It's the entire foundation of how he invests. He doesn't buy stocks, he buys pieces of businesses, and he only buys ones he'd be happy holding for a decade or more. Ask yourself this: would you be okay owning a company if the market shut down for 5 years? That's the Buffett test. If the answer is no, you probably don't understand the business well enough or don't trust it enough to weather the storm. Second, look for strong fundamentals. Do not chase trends. Look at the numbers. Ask yourself, does this company make money consistently? Does it have loyal customers? Does it have pricing power? Meaning, can it raise prices without losing people? Think of a local coffee shop. If it has regulars who come in every day, no matter what, and it can charge an extra 50 cents for coffee without losing customers, that's pricing power. That's a moat. Now, apply that to a company like Apple. Loyal users, consistent revenue, and the kind of brand that people stick with through thick and thin. That's why Buffett buys and holds Apple. Third, buy when there's blood in the streets. That's the old saying, and Buffett lives it. He doesn't wait for perfect timing. He buys when prices are low, even if they might go lower, because he knows he's getting value. Let's say you wanted to buy a car. You find one that's normally $30,000, on sale for $22,000. Someone tells you it might drop to $20,000 next week. Do you wait, risking it sells out? Or do you buy now, knowing it's already a good deal? Buffett chooses the latter. He buys the business at a discount and holds it, trusting time and performance will do the rest. Fourth, avoid overreaction. Do not check stock prices obsessively. If you're not willing to own a stock for 10 years, don't own it for 10 minutes. That kind of patience is rare, especially in today's dopamine-fueled, headline-driven world. It's easy to get caught up in daily market moves, but markets are noisy. One tweet from a politician or one bad earnings call doesn't mean a company is doomed. Buffett ignores the static and sticks to his thesis. Fifth, cash is a position. Always keep cash on hand. Not because of rainy days, but because it gives you flexibility. When everyone else is tapped out, you can find solid stocks for a highly cheap valuation. That's the Buffett mindset in a nutshell. You don't need billions or insider access to follow this path. You just need discipline. You need a plan. You need to ask, what am I investing in? Why do I believe in it? And can I sleep at night if it drops tomorrow? Because here's the truth. Nobody knows where the bottom is. Not Buffett, not hedge funds, not your favorite TikTok investor. But Buffett knows that buying solid businesses at good prices, holding them long-term, and ignoring the noise works. It's worked for decades. Through wars, crashes, pandemics, and now tariff shocks and global shakeups. And it can work for you too. Want to know Warren Buffett's crash-proof strongest bets for 2025? Click the video on screen to find out.